All right, so if you're watching Palantir right now, you know earnings are just breathing down our necks. And the stock, well, it feels kind of stuck, right? Just treading water. But what if that sideways movement is actually a hidden opportunity? Today, we're going to break down a really cool income-generating strategy that's built for exactly this pre-earnings limbo. So here's our game plan. We'll start with the pre-earnings puzzle and figure out why the stock's been sliding. Then we'll talk about the opportunity that all this uncertainty creates. After that, we dive into the strategy itself, the income generator, and I'll show you exactly why it's such a smart play. And finally, we'll wrap it all up with the final verdict. Let's get into it. Okay, so here's where Palantir is sitting right now, about $146 a share. And for a while, it's really just been bouncing around in a range, between about 130 and 170. It's got a lot of people scratching their heads and wondering, okay, what's next?
And this isn't just aimless wandering. According to the analysis, the stock is in what they call a corrective phase. Now, what that really means is uncertainty. It creates a lot of doubt for investors who are wondering if they should buy, sell, or just hold on for dear life. And that uncertainty, that's the very problem we're going to solve today.
So let's play detective for a minute. We need to get to the why. Because if you don't understand why the price is doing what it's doing, you can't see the opportunity that's hiding in plain sight. The source material boils it down to three things. First, something called valuation fatigue. Look, a price-to-earnings ratio over 230 is, well, it's steep, and that's making the market a little bit hesitant. Second, there's a technical correction. The stock is dipped below some important trend lines, which to chart watchers is a sign that it might head lower. And finally, you've got the classic pre-earnings chop. Everyone's just kind of holding their breath in a wait-and-see mode before the big report on May 4th. Okay, now here's the fun part. This is where we flip the script. All that uncertainty and nervousness we just talked about, it actually creates a really powerful financial opportunity if you know where to look. And that opportunity has a name, implied volatility, or IV for short. You can think of it like the market's anxiety meter. When people are unsure about what's going to happen, like right before an earnings report, that IV gets really high. It just swells up. And here's the key. Higher IV means that the prices of options, the premiums you can get for selling them, get way, way juicier. It's basically the market paying you to take on its uncertainty. And check this out. Right now, for Palantir options that expire right after earnings, the IV is hovering around 60%. That is high. And that high IV, that is the rocket fuel for the entire strategy we're about to lay out. It's what makes the whole thing work. All right, let's get to the main event. The strategy is called the income generator, and it's all about using a tool called a cash-secured put to literally get paid to just wait. So what the heck is a cash-secured put? It's simpler than it sounds, I promise. You sell what's called a put option. That's just a contract where you agree to buy 100 shares of a stock at a set price, the strike price, if the other person wants to sell them to you. And for taking on that obligation, you get paid cash, a premium right up front. The cash secured part just means you have the money in your account ready to go in case you have to buy the shares. Simple as that. So here are the nuts and bolts of the play from this source. The strategy is a cash secured put. The expiration date is May 8th, so right after the earnings news is out. The strike price we're looking at is $130. And now for the best part, the premium. For selling just one of these contracts, you could collect between $450 and $550. Let that sink in. You were getting paid up to $550 to simply agree to buy Palantir at a big discount to where it's trading today. Okay, but why this play? Why does it make so much sense right now? Let's dig into the logic and what makes this a really calculated move with a built-in margin of safety. This isn't just a random guess.
The secret sauce is this number right here, $130. If you look at the stock chart, this level has been like an iron floor of support. Ever since January, whenever the stock has dropped to this price, buyers have flooded in and propped it back up. So you're basically setting your buy-in price at a level that is proven to be incredibly strong. And I love this quote because it perfectly captures the mindset. You're not just trading an option, you're making a statement. You're saying, hey market, I am absolutely willing to buy Palantir, but at my price, at an 11% discount. And you get paid while you wait for the market to come to you. And let's just run the math to see how powerful this is. The stock's at $146, but let's say you sell that $130 put and collect a $5 premium. Well, your real break-even price isn't $130, it's $125. The stock has to fall all the way down to $125 before you'd even start to lose a penny. That is a massive cushion. But wait, there's another way you can win.
It's a beautiful thing called the IV crush. Here's how it works. Step 1. You sell the option before earnings when that IV is super high. Step 2. The earnings report comes out. Step 3. Poof. All that uncertainty disappears, and the IV gets crushed. It collapses. That instantly makes the option you sold way cheaper, so you can often buy it back for a quick profit. Sometimes it doesn't even matter which way the stock moved.
All right, let's bring it all home. Let's tie all these pieces together and give a final verdict on this pre-earnings strategy.
At the end of the day, what this is all about is changing your mindset. This isn't about trying to be a psychic. It's not about guessing if earnings are going to be amazing or terrible. It's about being disciplined. You define the price where you believe Palantir is a fantastic investment, and then you collect cash from the market for your patience.
So the question this explainer leaves us with is this. Are you really taking a huge risk here? Or are you getting paid to wait for a price that big-time institutions, the ones with $100 million research departments, would probably consider an absolute steal? That's definitely something worth thinking about.